IRAs, independent or individual retirement accounts. Let's see what we got here. Now, think 401ks, think retirement, all that good stuff. We've got three types we're going to go through here. Now, generally, what would you see in your world? I mean, at least for me, I'm pretty much seeing traditional deductible IRA and Roth IRA. However, this is another option. We'll talk about it, treat it as if it is equal here. Contributions to a traditional deductible IRA are made with pre-tax dollars and are deductible on the taxpayer's income tax return. And before I even dive into this, I'll make it a little more clear. So your regular IRA is essentially the same thing as a 401k, except you do it by yourself. It's not sponsored by an employer, so it's the same thing. And if any of you have contributed to your 401ks, to which I say great, I hope it works out. I hope you get to retire early. Maybe throw some my way if that would not harm you too much. So this is the same thing here, and it comes out of your paycheck, and you don't get taxed on that money. However, when you have to retire, or when you do retire, that money will be taxed. It's considered ordinary income. Now, how do you remember the difference between IRA and Roth IRA? Well, I think of Roth IRA, where that is after-tax dollars, as we see here. I'm jumping around the slide, I know, I'm going out of order. I'm the absolute worst. This is after-tax dollars, so let's say you get paid, you take your money, you throw it in your Fidelity Roth IRA, and then when you're 59 and a half, or we'll talk about that in a second, when you're at retirement age, you're not taxed on that at all. So the difference in how I remember that is if you think you're going to be super wealthy when you're older, and maybe that's because you get pension payments and dividends and you're getting a lot of investments and interest and all of that, think about it like you're wealthy, right? Rothschild, that's kind of how I remember it, super wealthy. So you would prefer a Roth IRA because you pay tax now when you're younger and you have a lower tax rate. And again, if you think you're going to have a lot of money in the future, if you're going to have a lot of income in the future, you probably want to contribute to a Roth IRA. Pay tax now when you have a lower tax rate, receive the money tax-free later in your future when you have a higher tax rate. And then on the flip side, and not giving you advice here, I mean, please look at, I do advise you look into this, talk to someone for yourself so you understand how this all works if you're not familiar. For a traditional IRA, this is going to be, again, kind of like a 401k, and there's nothing wrong with either of them. I personally contribute to both because who the hell knows what my future is going to look like. So some of it will be taxable, some of it will be non-taxable. This is going to be pre-tax dollars. Now, how does it work if you do your own traditional IRA? And why am I talking about this? Is this important for the exam? Yeah, I think it is to understand how this all works. Now, for your 401k, it's pretty easy, right? It's just your employer takes it out of your paycheck. Boom, done. However, what happens if you don't work for an employer or you additionally want to contribute to a normal IRA? What happens is you use post-tax dollars, after-tax dollars. You put it into that same Fidelity account, except this Fidelity account, I mean, it's not the same account. It's you have two with Fidelity or Vanguard or whoever, and it is going to be money after tax. But then on your individual tax return, you say that you put in, let's say, $4,000 to your IRA, and you can use that as a deduction because you didn't have the benefit of an employer deducting it out of your paycheck for you. So that's how that works. So just good overall idea of everything here. Definitely need to understand retirement accounts. Where does this fit in? You can see multiple choice questions on it. And very commonly, you'll have a SIM that is one big 1040, one big individual return, and you've got a lot of different exhibits. Now, it's pretending like you're a tax return preparer. Like a client comes in, gives you their retirement account paperwork, their dividends from their normal investment account, their W-2, and you have to prepare their tax return. So that's why all this is important to understand. And hey, like I always say, a lot of this stuff, you can use it in your own real world, in your life. Maybe this will help you out, give you some insight into how investing, retirement, all that good stuff works. If we ever do get to retire, I don't really foresee that happening. But anyway, let's run through the actual slide now that I'm done giving you examples. A lot of wealth of knowledge I remember from past couple of years. Traditional deductible IRA contributions to this type of account are made with pre-tax dollars and are deductible on your tax return. Now again, same thing as a 401k, except 401k is sponsored by an employer. Deductible on the tax return, which essentially makes it pre-tax dollars because it's a deduction. Now, when funds are withdrawn from the account, both the principal, if a deduction was taken when contributed, and the earnings are taxed as ordinary income. At age 72, the taxpayer must begin taking required minimum distributions from the account. And we see here, I'm jumping around, you know it, I'm making you lose your mind. Not just being dynamic. 59 and a half is when you can start withdrawing, and by age 72, you have to start withdrawing. So it's between those ages you're going to be withdrawing. At age 72, this is just an age to remember. You have to start taking money out of it. You can't just let it keep compounding and compounding. Right? There's a lot of rules with all this. Now, a traditional non-deductible IRA, contributions to a traditional non-deductible IRA, these are made with after-tax dollars and are not tax deductible. When funds are withdrawn from the account, the principal is not taxed, but the earnings are taxed as ordinary income. Now, similar to traditional deductible IRA, we have this age 72 for our RMDs. So it's just difference in the taxation of the principal. You just see the differences there. Now we get to our Roth IRA. Now, contributions to a Roth IRA are made with after-tax dollars. Again, it's like you get your paycheck, you see $1,000 in your bank account, you take 500 of those dollars, you throw it into your Vanguard Roth IRA, and that's it. You don't get a benefit right now. The benefit you do get is that when you withdraw funds from the account, the principal is not taxed, and the earnings, any income generated from those investments, are tax-free if the distribution is qualified. Now, what is a qualified distribution? We've got a following items here. We got a few things. It's made at least 5 years after the first contribution is made, so got a little time frame there. These are more common ones that you may have heard of. So taxpayers 59 and a half or older, and these apply to all of your accounts. You have to be 59 and a half or older. Taxpayer is disabled, so one of the following, you don't have to be disabled as well as 59 and a half. So one of these things. And this item here, letter C, this is kind of not a requirement to normally do this. This is a one-time thing. So if you're a first-time home buyer or you've not owned a home in 2 years, you can withdraw $10,000 without penalties, and that's a qualified distribution. Why is that? Well, generally the tax code exists to help stimulate the American economy. And what does that mean? Well, that means benefiting farming and special interest groups and also the American dream, real estate, right? So there's a lot of items in the tax code that help purchase homes. That's why there's the exclusion on the gain on a sale of a primary residence, which if you haven't seen that yet, we will see that as we dive through our lessons. Lots of different items that incentivize people to go and buy a home because, again, that's the American dream. Property taxes, got to keep the economy flowing. So this is just an exception kind of thing. The normal distribution for just, let's say, not to call other people not normal, but statistically the most normal way, the most common way that people are going to withdraw their money is 59 and a half or older. You can start taking that money out, spend it on your wild cruises, Bahama vacations, all that good stuff. Now, distributions are assumed to come first from the principal. Those earnings are going to keep compounding. If a withdrawal is made before age 59 and a half and it does not meet any of the exceptions, so we talked about this home buyer one, but there are other exceptions. So health insurance, IRA owner's disability, medical expenses, death, education expenses. Not really the first home purchase is the one I'd say, let's know that. But the other ones, not too as important. But there are ever-changing ones. For example, if there are significant events in the United States and the IRS, the government says, there was a significant recession or there was a significant virus going around, something like that. There are temporary legislations that exist in order to help people to take money out of their retirement accounts and use it in those desperate times. However, we're not going to focus on that because that is ever-changing. Now, if you do not meet any of these exceptions, you have to pay regular tax on that as if it was a normal investment account, and you get slammed with a 10% penalty for the withdrawal. Just something to keep in mind. This money isn't locked away. I mean, you can access it at any time. However, you're going to be hit with that 10% penalty and have to pay normal taxes on it. That was a big old lesson on retirement accounts. Gotta love it. Lots of important stuff to see here. And other things before I move along on this slide. For one, I would definitely recommend take a look at the 1040, see where these go on the face of the 1040. Just like many other things I'll say. Take a look at where the interest income goes on the 1040, the dividend income. If the more you do that, the more you'll be able to visualize where all these things go, especially if you're not as familiar with taxes. And that way on the exam, you'll close your eyes, you'll visualize it, you'll say, I know if that's above the line or below the line, or if it's includable in gross income, where it goes, what it affects, what comes before it, what comes after it. And trust me, that will all be important, especially for Sims. Lastly, there are annual limits to how much you can contribute to these accounts, and those are ever-changing. Those change pretty much every year with inflation. Those will be included in the resources, and you should memorize those amounts. However, again, those do change pretty much every year, so make sure you memorize the current ones for your exam. All right, now we can move along. Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.